You know, I've lived through more recessions than most people have had hot dinners. The crash of 1973 and 1974, Black Monday in 1987, the dot-com bubble bursting in 2000, the financial crisis of 2008, and most recently, the pandemic-induced chaos of 2020. Each one taught me something different, but they all reinforce the same fundamental truth. When the economy goes into a tailspin, most investors panic and make the worst possible decisions at the worst possible time. I've spent my entire career, more than 7 decades now, studying businesses and trying to understand what makes them tick. And if there's one thing I've learned, it's that recessions don't just test businesses, they reveal their true character. When the tide goes out, as my mentor Ben Graham used to say, you find out who's been swimming naked. Most companies look great when the economy is humming along. But when times get tough, when consumers tighten their belts and credit freezes up, that's when you see which businesses have real staying power and which were just riding the wave. People often ask me what I'd do differently if I were starting over today. They want to know if I'd change my approach, if I'd adapt to this new world of technology and rapid change. And my answer is always the same. The principles don't change. Human nature doesn't change. Fear and greed still drive markets. And recessions are still the greatest opportunity for patient investors who know what they're looking for. Now, I'm not going to sit here and tell you I can predict when the next recession is coming. Anyone who claims they can time the market is either lying or delusional. I've never been able to do it, and I've been at this game for more than 70 years. But what I can tell you is this: recessions are inevitable. They're as much a part of the economic cycle as expansion and growth. And when the next one hits, and it will hit, you want to own businesses that won't just survive, but will actually come out stronger on the other side. So if someone put a gun to my head today and forced me to pick just 3 stocks to hold through the next recession, stocks I'd be willing to bet my entire fortune on, I know exactly what I'd choose. These aren't hot tech startups or trendy growth stocks. They're not going to make you rich overnight. But they're businesses I understand, businesses with competitive advantages so strong that even a severe recession can't break them, and businesses run by people I trust to make smart decisions when things get ugly. Let me tell you about the first one, and this might surprise some people, but it shouldn't. It's Apple. Now, I know what you're thinking. Warren Buffett, the guy who avoided technology for decades, the guy who famously said he didn't understand Microsoft or Google, is putting a tech company at the top of his recession list. But here's the thing. I don't think of Apple as a technology company anymore. I think of it as a consumer products company that happens to use technology. Berkshire Hathaway first started buying Apple shares back in 2016. I was late to the party, I'll admit that, but better late than never. And since then, it's become our largest equity holding by far. At last count, we own more than 900 million shares, worth well over $150 billion. That's about 40% of our entire equity portfolio sitting in one stock. People sometimes ask me if I'm worried about that concentration. My answer is no. I'm worried about not owning enough of it. What makes Apple such a perfect recession stock? Let me break it down for you. First, and this is crucial, Apple has created an ecosystem that customers simply don't want to leave. It's not just about having a good phone. It's about the way that phone connects to your watch, your tablet, your computer, your TV, your headphones. It's about all your photos and messages and apps working seamlessly together. It's about the fact that switching to a competitor means giving up convenience that you've become accustomed to. I call this a moat, a competitive advantage that's extremely difficult for competitors to cross. And Apple's moat might be the widest I've ever seen in a consumer products company. Think about it. During a recession, when people are watching every penny, are they really going to switch from an iPhone to save a couple $100 if it means losing access to all their purchased apps, their iCloud storage, their AirPods integration, and the seamless connection with their MacBook? Most won't. The switching costs are just too high, both financially and psychologically. Second, Apple has demonstrated time and time again that it can maintain premium pricing even when the economy is struggling. Look at what happened during the 2008 financial crisis. While other phone makers were slashing prices and watching their margins evaporate, Apple kept prices steady and actually gained market share. The same thing happened during the pandemic. In 2020, when the world was falling apart, Apple had one of its best years ever. This is the beauty of a premium brand with loyal customers. Apple users aren't just customers, they're fans. They're members of a tribe, and during tough times, people are actually less likely to trade down from premium brands they love because those products represent stability and quality when everything else feels uncertain. An iPhone isn't just a phone, it's a statement about who you are and what you value. Third, let's talk about Apple's balance sheet, because this is where things get really interesting from a recession standpoint. The company has over $60 billion in net cash. That's cash and marketable securities minus debt. During a recession, cash is king. It gives you options. It lets you invest in innovation when competitors are cutting back. It allows you to buy back shares at depressed prices. It provides a cushion against declining sales. Apple isn't going to be scrambling for financing when credit markets freeze up. They're going to be one of the few companies with the resources to actually take advantage of the chaos. And fourth, Apple has proven it can generate enormous amounts of cash flow regardless of economic conditions. We're talking about a company that produces nearly $100 billion in free cash flow every year. That's cash that's available to return to shareholders through dividends and buybacks or to invest in new products and services. During the last recession, Apple's cash flow actually grew. Think about that. While most companies were struggling just to stay afloat, Apple was printing money. But here's what really makes Apple a perfect recession stock, and this is something a lot of people miss. The company has been systematically shifting its business model towards services. Things like the App Store, Apple Music, iCloud storage, Apple TV Plus, and Apple Pay. These are recurring revenue streams that are much more stable than hardware sales. If someone already owns an iPhone, they're probably going to keep paying for their iCloud storage even if times get tough. They're not going to cancel their Apple Music subscription to save $10 a month. These services have incredibly high profit margins, and they're growing faster than the hardware business. So when I look at Apple, I see a company with a wide moat, premium pricing power, a fortress balance sheet, enormous cash generation, and an increasingly recession-resistant business model. That's exactly what you want to own when the economy goes into a downturn. The stock price might fall during a recession, sure. Everything falls during a panic. But the business will keep humming along, generating cash and gaining market share while weaker competitors fall by the wayside. Now, my second pick is going to be even less exciting to some people, but it's a business I know intimately and trust completely. It's Coca-Cola. We've owned Coke stock since 1988, and I've said many times that I'd be perfectly happy owning it forever. In fact, I wish I'd bought more of it earlier. But 36 years of owning this stock has taught me everything I need to know about how a truly great business performs during recessions. Let me tell you a story. Back in the Great Depression of the 1930s, when unemployment hit 25% and the economy shrank by nearly 30%, what do you think happened to Coca-Cola? The company not only survived, it actually thrived. Sales volumes held steady, the brand got stronger, and when the economy recovered, Coke was in an even more dominant position than before. That's the sign of a recession-proof business. Why is Coca-Cola such a perfect recession stock? Well, first and foremost, it sells happiness in a bottle for pocket change. During tough economic times, people cut back on big purchases. They stop buying new cars. They postpone home renovations. They skip expensive vacations. But they don't stop buying small, affordable luxuries that make them feel good. A Coke costs, what, $2, $3? For most people, that's an affordable treat, even when money's tight. It's what economists call an affordable luxury, something that provides a psychological boost without breaking the bank. I've watched this play out over and over again during recessions. People will brew coffee at home instead of going to Starbucks. They'll cook dinner instead of eating at restaurants. But they'll still grab a Coke from the vending machine or pick up a 12-pack at the grocery store. The product is so cheap relative to the value it provides that demand stays remarkably stable even during severe economic downturns. Second, Coca-Cola has the most valuable brand in the world. I'm not exaggerating. Study after study ranks Coke as one of the top 3 most recognized and valuable brands globally, right up there with Apple and Google. That brand is worth hundreds of billions of dollars, and it's a massive competitive advantage. Generic cola costs half as much, but people still choose Coke. Why? Because the brand means something. It represents reliability, quality, tradition, happiness. Those associations are incredibly powerful, and they're actually more important during recessions when people crave familiarity and trust. Third, let's talk about Coca-Cola's distribution system, because this is one of the most underappreciated aspects of the business. Coke products are available everywhere. I mean everywhere. Grocery stores, convenience stores, restaurants, vending machines, stadiums, theme parks, gas stations. If you're in the United States, you're never more than a few hundred yards from a Coca-Cola product. That ubiquity is nearly impossible for competitors to replicate. And it's incredibly valuable during a recession because it means Coke doesn't have to fight for shelf space or distribution. They already have it locked up. Fourth, Coca-Cola's business model is beautifully simple and capital efficient. The company doesn't actually bottle and distribute most of its products. Instead, it sells concentrate to independent bottlers who handle the capital-intensive parts of the business. This asset-light model means Coca-Cola can generate returns on invested capital that most businesses can only dream of. And during a recession, when access to capital gets expensive and difficult, having a business model that doesn't require constant reinvestment is a huge advantage. But here's what really seals the deal for me on Coca-Cola as a recession stock. The company has raised its dividend every single year for the past 61 consecutive years. Let me repeat that. 61 years. Through recessions, inflation, wars, pandemics, financial crisis, everything the world has thrown at it, Coca-Cola has increased its dividend every single year. That's not just a testament to the quality of the business. It's a commitment to shareholders that I take very seriously. During a recession, when stock prices are falling and panic is setting in, receiving a growing dividend check every quarter provides psychological comfort and tangible returns. It reminds you that the business is still generating cash, still profitable, still committed to rewarding shareholders. And for retirees or people depending on investment income, that reliability is priceless. You can't eat capital gains, but you can cash dividend checks. I remember during the 2008 financial crisis, I had people calling me in a panic, asking if they should sell everything and hide in cash. My answer was always the same. If you own great businesses with strong competitive advantages and the ability to keep paying dividends, why would you sell them at depressed prices? Just keep collecting those dividends and wait for the storm to pass. And that's exactly what we did with Coca-Cola. We collected our dividends, we watched the stock price eventually recover, and we came out just fine on the other side. Now, Coca-Cola isn't going to give you explosive growth. The company grows revenues at maybe 3 to 5% a year in a good environment. During a recession, it might not grow at all, but it also doesn't shrink much. And when you factor in the dividend, which currently yields around 3%, you're getting a pretty attractive total return from a business that's about as stable and predictable as they come. That's exactly what you want when the economy is falling apart and uncertainty is high. People sometimes criticize me for being too conservative, for missing out on high growth opportunities. And maybe they're right. Maybe I should have bought Amazon 20 years ago. Maybe I should have loaded up on Netflix. But here's my philosophy. I'd rather own a business, I completely understand, that generates steady cash flow and pays reliable dividends than chase the latest hot thing that could flame out when times get tough. Coca-Cola might not be sexy, but it's proven over more than a century that it can survive and thrive through any economic environment. And in a recession, boring and reliable beats exciting and uncertain every single time. My third pick is going to surprise exactly no one who's followed my career. It's Berkshire Hathaway itself. Now, I know what you're thinking. That's cheating, Warren. You can't pick your own company. But hear me out, because I'm dead serious about this. If I could only own 3 stocks through the next recession, Berkshire would absolutely be one of them. And there are very specific reasons why. First, let me tell you what Berkshire actually is, because a lot of people misunderstand the company. We're not just an insurance company or an investment firm. We're a diversified conglomerate with over 60 wholly owned operating businesses, a massive stock portfolio, and one of the largest insurance operations in the world. We own everything from railroads to utilities to candy companies to furniture stores. We sell paint, we make tools, we distribute auto parts, we provide electricity to millions of homes, we insure cars and homes and businesses. This diversification is absolutely critical during a recession. When one part of the economy struggles, other parts hold steady or even benefit. If consumers stop buying furniture, they're still eating candy. If manufacturing slows down and railroad volumes decline, people are still paying their insurance premiums. If residential construction falls off a cliff, utilities keep collecting monthly bills. No single industry downturn can seriously damage Berkshire because we're exposed to so many different sectors. But diversification alone doesn't make Berkshire a great recession stock. What really sets us apart is our balance sheet, and this is something I'm incredibly proud of. Berkshire typically holds between $150 billion and $200 billion in cash and short-term treasury bills. People sometimes criticize me for holding so much cash, saying it's a drag on returns. They want me to deploy that capital to buy more businesses, to juice returns, but they're missing the point entirely, that cash isn't dead money. It's ammunition, it's optionality, it's insurance against disaster. During a recession, when credit markets freeze up and businesses are desperate for capital, having $150 billion in cash makes you one of the most powerful players in the world. We can make deals that nobody else can make. We can buy businesses at fire sale prices. We can provide financing when banks won't. We can buy back our own shares when they're trading for less than intrinsic value. Let me give you a concrete example. During the 2008 financial crisis, when the world was on the brink of financial collapse, Berkshire was able to write billion-dollar checks to companies like Goldman Sachs, General Electric, and Bank of America. We got incredible terms on those deals because we were one of the few entities with both the capital and the willingness to deploy it when everyone else was frozen in fear.
Those investments made us billions of dollars and reinforced Berkshire's reputation as the lender of last resort. That's the power of having a fortress balance sheet during a crisis.
Second, let's talk about our insurance operations, because this is the engine that makes everything else possible. Insurance is a beautiful business during normal times, but it's an even better business during recessions. Why? Because insurance premiums are non-discretionary spending. You can't just cancel your car insurance or homeowner's policy because the economy is struggling. Laws and mortgage companies require you to have it. So premium revenue stays remarkably stable even during severe downturns. But here's where it gets really interesting. Insurance companies collect premiums up front and pay claims later, sometimes years later. That gives us what I call float, money we get to invest but don't actually own. Right now, Berkshire has about $165 billion in float. That's $165 billion we're investing in stocks and bonds and businesses, earning returns on money that isn't technically ours. And during a recession, when stock prices fall and bond yields spike, we can invest that float at much more attractive rates than we could during good times. Third, many of Berkshire's wholly owned businesses have the same recession-resistant characteristics I look for in stocks. Our utilities don't see demand drop during recessions because people still need electricity and natural gas regardless of the economy. Our railroad, BNSF, sees volumes decline but remains profitable because it's such a low-cost way to move freight. Our insurance companies keep collecting premiums. Even our consumer businesses, like See's Candies and Dairy Queen, hold up remarkably well because they sell affordable treats. But here's what really makes Berkshire special as a recession stock. The company is designed to survive anything, and I mean anything. A Great Depression, a financial crisis, a pandemic, even a nuclear war. That might sound dramatic, but I'm completely serious. Our balance sheet is so strong, our businesses are so diversified, our management team is so capable that I can't envision a scenario where Berkshire doesn't survive and eventually thrive. That's not true of most companies. During severe recessions, even good businesses can fail if they're over-leveraged or dependent on access to credit markets or concentrated in struggling industries. But Berkshire, we could hunker down, stop making acquisitions, live off the cash flow from our operating businesses, and wait out even the worst economic storm. And when things eventually recover, as they always do, we'd be in a position to deploy capital aggressively and take advantage of opportunities that others missed. I've structured Berkshire this way very deliberately. I've watched too many businesses and investors get wiped out during recessions because they were running too lean, because they didn't have margin for error, because they assumed good times would last forever. I never want to be in that position. I always want Berkshire to be the strong one, the one with options, the one that can be greedy when others are fearful. There's another aspect of Berkshire that makes it ideal for recessions that people don't always appreciate. The company has no meaningful debt at the parent company level. Zero, zilch, none. Our operating businesses have some debt, particularly the railroad and utilities, which are capital-intensive businesses where modest leverage makes sense. But at the holding company level, where decisions get made, we have no debt coming due, no refinancing risk, no interest payments that have to be made regardless of business conditions. This is crucial during a credit crisis. In 2008, I watched solid businesses with good operations get destroyed because they had debt maturing and couldn't refinance it. Banks weren't lending. Credit markets were frozen. And if you had $1 billion loan coming due, you were in serious trouble regardless of how good your business was. Berkshire will never be in that position. We'll never be forced to make bad decisions because of debt maturities or bank covenants. We control our own destiny. Let me also talk about share buybacks for a moment, because this is an important part of the Berkshire investment thesis during recessions. We have a policy of buying back Berkshire shares when they trade below what Charlie Munger and I believe is intrinsic value. During recessions, when fear dominates and stock prices fall, Berkshire shares often trade at significant discounts to what the business is actually worth. That creates an opportunity for us to buy back shares at bargain prices, which increases the per share value of the company for all remaining shareholders. This is one of the best uses of capital during a recession. If our stock is trading for 70 or 80 cents on the dollar of intrinsic value, buying back shares is like buying $20 bills for $15. It's a no-brainer. And because we have so much cash and such strong cash generation from our operating businesses, we can be aggressive with buybacks when prices are depressed without jeopardizing our financial strength. That's a huge advantage for long-term shareholders. Now, I want to step back and talk about what these three stocks have in common, because that will tell you everything you need to know about my investment philosophy during recessions. First, all three are businesses I understand completely. I know how Apple makes money. I know how Coca-Cola makes money. I obviously know how Berkshire makes money. There's no mystery, no black box, no technology I can't comprehend. This is critical during a recession when uncertainty is high and fear is rampant. If I don't understand a business, I can't have confidence in its ability to weather a storm. Second, all three have wide competitive moats. Apple has its ecosystem and brand. Coca-Cola has its brand and distribution network. Berkshire has its diversification, balance sheet, and reputation. These moats protect the businesses during downturns and ensure that when the economy recovers, they'll still be in dominant positions. Companies without moats get picked apart by competitors during recessions as everyone fights for survival. Companies with strong moats can actually gain ground. Third, all three generate enormous amounts of cash. This is perhaps the most important characteristic of all. During a recession, cash flow is everything. Sales might decline, profits might fall, but if a business can keep generating cash, it can survive. And if it generates enough cash, it can thrive by investing countercyclically when everyone else is retrenching. Apple, Coca-Cola, and Berkshire are all cash-generating machines. Fourth, all three have strong balance sheets with minimal debt. This gives them flexibility and options during crises. They're not at risk of bankruptcy or financial distress. They can make opportunistic acquisitions. They can buy back stock. They can maintain dividends. They control their own destiny rather than being dependent on the kindness of bankers and credit markets. And fifth, perhaps most importantly, all three are run by capable management teams that have proven they can navigate difficult times. Apple's management has shown remarkable discipline and strategic vision. Coca-Cola's management has successfully navigated more than a century of booms and busts. And Berkshire's management, well, I obviously have strong opinions about their capabilities. During a recession, management quality matters more than ever because difficult decisions have to be made and the margin for error shrinks. Let me also talk about what's not on my list, because that's equally instructive. You won't see any high-flying growth stocks that trade at massive multiples of sales with no earnings. You won't see any speculative plays on emerging technologies. You won't see any companies that require everything to go right to justify their valuations. Those kinds of investments might make sense during boom times when risk appetite is high and capital is cheap, but during a recession, they get slaughtered. I learned this lesson painfully back in the 1970s when I owned some growth stocks in the Nifty 50, the group of hot companies everyone thought would grow forever. When recession hit and the market crashed, those stocks fell 70, 80, even 90%. Meanwhile, boring businesses with stable cash flows and reasonable valuations held up much better. That experience shaped my entire investment philosophy. It taught me that preservation of capital during downturns is just as important as growth during upturns. You also won't see any banks on my list, despite the fact that we own significant stakes in several banks. Banking is a fundamentally different business during recessions. Credit losses spike, loan demand falls, and the entire system comes under stress. Even well-run banks face challenges during severe downturns, and poorly run banks can fail completely. I'd rather own businesses whose economics actually improve during tough times, or at least stay stable. Similarly, you won't see any retailers or restaurants or hotels or airlines. These are great businesses during expansions, but they're highly sensitive to economic cycles. When consumers pull back spending and business travel declines, these companies suffer. Fixed costs don't disappear just because revenue falls. Restaurants still have to pay rent and staff. Hotels still have debt service. Airlines still have massive capital costs. These businesses can be great investments at the right price, but they're not what I'd want to own going into a recession. Now, let me address something important. Some people might look at my three picks and think, Warren, these are huge companies. Apple's worth $3 trillion. Coca-Cola's worth $250 billion. Berkshire's worth almost $1 trillion. Surely smaller companies offer better opportunities. And my answer is maybe, but probably not during a recession. During recessions, size and financial strength become huge advantages. Large companies have access to capital markets. They have diversified revenue streams. They have the resources to invest countercyclically. They can acquire smaller, struggling competitors. Small companies, even good ones, often struggle during recessions because they lack these advantages. They're more dependent on bank financing, which dries up during crises. They have less room for error. A small company losing one major customer might face bankruptcy. A giant like Apple losing one customer is meaningless. I've also learned that liquidity matters during crises. If you own a small company and need to sell shares during a recession, you might struggle to find buyers. Or you might have to accept a terrible price because the market is so thin. But Apple, Coca-Cola, and Berkshire, you can sell millions of dollars worth of shares at any time and barely move the market. That liquidity provides peace of mind and optionality. Let me talk about timing for a moment, because this is where a lot of people get themselves in trouble. They think Warren is warning about a recession, so I should sell everything and wait for the crash, then buy his three stocks at the bottom. And that's exactly the wrong way to think about it. Here's why. I have no idea when the next recession is coming. It could be next month. It could be 3 years from now. And more importantly, I have no idea what stock prices will do in the meantime. If you sell today to wait for a recession, you might miss significant gains. Apple could double before a recession hits. Then when the recession finally arrives, maybe it falls 40%. Well, you're still worse off than if you just held the whole time. Plus, you have to be right twice. First, you have to sell at the right time. Then you have to buy back at the right time. And I've never seen anyone consistently do both. My approach is different. I buy businesses I'd be happy owning forever, and I hold them through recessions. Yes, the stock prices fall during downturns, sometimes significantly. But the businesses keep generating cash, they maintain their competitive positions, and they eventually recover. And while I'm waiting, I'm collecting dividends from Coke and watching all three companies invest for the future at attractive returns. This is what I mean when I say my favorite holding period is forever. It's not because I think stock prices only go up. They don't. It's because the businesses I own have the characteristics to survive and thrive through complete economic cycles. And over time, over decades, that compounds into extraordinary wealth. The key is being patient enough and having a strong enough stomach to hold through the scary times. I remember during the 2008 crisis, Berkshire shares fell more than 50% from their peak. People were panicking, some shareholders were selling, and I got letters asking if the company was going to survive. My answer was always the same. Berkshire's fine. The businesses are generating cash. The balance sheet is strong. This too shall pass. And it did. Within a few years, we'd hit new all-time highs. The people who sold in panic locked in losses and missed the recovery. The people who held or bought more did very well. That's the real test of a great recession. Stock. Not whether the price falls, because everything falls during a panic, but whether the business stays healthy and eventually recovers. Apple, Coca-Cola, and Berkshire all passed that test with flying colors. I've seen them do it multiple times. And I'm confident they'll do it again during the next recession, whenever it comes. Let me also address something that younger investors sometimes struggle with. They look at my portfolio and think it's too conservative, too old-fashioned, too boring. They want excitement. They want stocks that could 10x in a year. They want to get rich quickly. And I understand that impulse. I was young once too. But here's what I've learned over 7 decades. Getting rich slowly is a lot more reliable than trying to get rich quickly. And more importantly, staying rich is even harder than getting rich in the first place. These 3 stocks represent the foundation of a portfolio that can survive anything. They're not going to make you a millionaire overnight, but they're also not going to blow up in your face during the next financial crisis. They're the kind of investments that let you sleep at night knowing your capital is safe with capable businesses and management teams. And over time, the steady compounding of cash flows and reinvested dividends will build wealth more surely than chasing the latest hot stock. There's something else that's important to understand about recession investing. The goal isn't just to protect capital. It's to be positioned to take advantage of opportunities. During recessions, great businesses sometimes trade at ridiculous prices. I bought wonderful companies for 50 or 60 cents on the dollar during panics. But I could only do that because I had capital available. If I'd been fully invested in illiquid assets or levered up or holding risky positions, I wouldn't have been able to act. By owning Apple, Coca-Cola, and Berkshire going into a recession, I maintain optionality. These are liquid positions I could sell if I found something even more attractive. More likely, I just hold them and deploy cash from Berkshire to make opportunistic investments. But the point is having flexibility. Being fully invested in speculative positions removes that flexibility. You're forced to be a price taker rather than a price maker. I also want to talk about the psychological aspect of recession investing, because this is where most people fail. It's not that they don't know what to do intellectually. Most people understand that recessions are buying opportunities, that fear creates bargains, that you should be greedy when others are fearful. But when the moment actually arrives, when stock prices are falling 10% in a week and the headlines are screaming about depression and financial collapse, very few people can actually follow through. That's where owning high-quality businesses makes all the difference. When I look at my portfolio during a crash and I see Apple, Coca-Cola, and Berkshire, I'm not worried. I know these businesses will survive. I know they're generating cash. I know management is making smart, long-term decisions. That confidence allows me to hold or even buy more when everyone else is panicking. If I owned a portfolio of speculative junk, I'd be panicking too. The quality of your holdings directly impacts your ability to think clearly during crises. This is something Ben Graham taught me early on. He said the margin of safety principle isn't just about buying cheap. It's about buying quality businesses at reasonable prices so you can handle the inevitable volatility and uncertainty. A cheap stock that falls 80% is no bargain if the company goes bankrupt. A wonderful business, bought at a fair price, it falls 40% and then recovers is a much better investment. Apple, Coca-Cola, and Berkshire all provide that margin of safety. Let me wind this down with some final thoughts. If the next recession started tomorrow, would I be worried about my portfolio? No. Would I lose sleep wondering if Apple or Coca-Cola or Berkshire would survive? Absolutely not. Would I be looking for opportunities to deploy capital at bargain prices? You bet. That's the position you want to be in. Confident in your holdings, comfortable with volatility, and ready to act when others are frozen in fear. The three stocks I've laid out today aren't secrets. Everyone knows Apple, Coca-Cola, and Berkshire Hathaway. They're not hidden gems waiting to be discovered. But that's kind of the point. The best businesses are hiding in plain sight. They're so big and so obvious that people overlook them in search of the next big thing. But these companies have proven over decades that they can navigate any economic environment. That's worth more than any hot tip about an unknown company. Remember, investing successfully isn't about being clever or finding securities nobody else has heard of. It's about being patient, being rational, and owning quality businesses that can compound value over time. It's about avoiding permanent losses of capital rather than trying to maximize gains every single quarter. And it's about having the courage to hold wonderful businesses through temporary setbacks while everyone around you is losing their minds. So if I had to pick three stocks for the next recession, there you have it. Apple, Coca-Cola, and Berkshire Hathaway. Three businesses I understand. Three companies with wide moats and strong balance sheets. Three management teams I trust. Three cash-generating machines that have survived every crisis thrown at them. That's all I need. Everything else is just noise.